Can we start off by maybe doing some introductions? Nardo, would you like to just introduce yourself for a couple of moments?
Sure. Manaloto, managing partner of Qubits. Nardo Manaloto, managing partner of Qubits Ventures. I invest solely in early stage quantum tech companies globally. So hoping to have a good conversation here regarding what I look into and answer some of these interesting questions.
Olivier.
Hi, Olivier Tonneau, glad to be here. So I'm representing Quantonation, which is an early stage fund dedicated to investment in quantum technologies. Currently invested in 24 companies all around the world and investing in communications, computing, and also sensing. And one specificity of our team is that we have the team is made of half investors and half quantum physicists. So quite a balance, which we hope we will keep in the future.
Matt.
And so Matt Cost.
Is it switched?
Hi, all. Matt Cost, Airbus Ventures, one of the GP here. Airbus Ventures, despite the brand, is just a venture capital firm, like financial oriented. Airbus is group, corporate, is one of our LPs, but we are based on a typical LP-GP model. We are early stage, global deep tech. So early stage, we invest between seed and Series B. We lead or follow. So $500,000 up to $10 million US per round. Global. We are incorporated in the Delaware, headquartered in Menlo Park, California, with team on the East and West Coast in the US, here in Europe, France and Germany, and Tokyo, Japan to cover Asia Pac. And deep tech, we are very much thesis-driven. Computing is one of the themes we're investing in, and obviously it covers quantum computing, sensing, quantum memories, quantum, but as well chemistry-based computing, DNA-based storage, neuromorphic chips, so we're addressing those other elements of computing and transforming data. Beyond that, we talk space, deep tech, and other stuff that we may not go through today.
Thanks. My first theme isn't really quantum per se at all. It's the wider environment at the moment. I think the global environment seems difficult for venture capital at the moment. We had the post-pandemic tech market crunch. Some would say we're in a VC winter, and then we've had the Silicon Valley Bank debacle. So, Olivier, I wanted to come to you first. How easy is it to be a VC GP at the moment? And how does it look any different from a European and a US perspective?
Well, I think in quantum, we can hear people talking about quantum winter and how it's going to be difficult to find money. But if you look at the figures, there has been $2 billion invested in quantum in 2021. The same has been invested again in 2022. And if you look at the figures at first quarter this year, it's still going strong. So we don't see that happening. And I think one of the reasons it's not happening is because investment in the quantum technologies is still small. If you look at those 2 billion invested in quantum and you compare that to AI, I think the figure was 91 billion. So we are still far away from having a bubble or from having overflowing investment in the quantum industry. Now that being said, of course, it's difficult. I mean, for us, fund to find new investors because people, large investors who we talk to, are saying, why the hell would I invest in VC trying to get 12 to 15% return when I can invest in private debt at 7 or 8 with much less risk? So it's a bit difficult for us to find the money, but I can emphasize on the fact that we get good support from national authorities or supranational authorities such as Europe, which is compensating in part what is difficult to find for VCs. And if you look at startups, I think what's not going through anymore is large 500, 600 million deals and SPAC frenzy. But we are still having a lot of reasonable size deals from 10 to 30 million that are going through and that are going nicely.
Olivier set up the question that I want to come to yourself on now, because you mentioned the AI word. And obviously that's the other big thing that's going on in the wider market at the moment. And Nardo, is all that interest in AI, is that a distraction from quantum? Is that a problem or is it an opportunity?
It's definitely both, right? So typically, initially in the short term, there's a lot of people paying attention in the whole AI space because of the chat GPT moment, right? So eventually that kind of stuff will die down. From a long-term perspective, I think it's good for quantum. So initially when I'm looking at investing in this space overall broadly on quantum technologies, I didn't have a category for AI in quantum, in improving the quantum aspect, right? So all of a sudden, this actually opened up my eyes and said, okay, maybe we could use this technology to improve quantum technologies across the board, right, for the entire full stack. We haven't seen many startups in that space yet. I think we need to get probably educating people that that's also a potential startup potential, right? So to me, the short term is, yes, there's distraction there, but overall, long term, it'll be good for quantum perspective. The AI and quantum side of things, I think you're going to see a lot more of that. And then the other part of it is a lot of industries are already very familiar with AI. So what they're not familiar in is just quantum, right? So to me, it's more of like, if you push the AI conversation and just say, this is how it can improve AI and how quantum can, you can do things on both sides, make these two technologies work together, then you can see the power of that kind of impact to an enterprise. You just have to explain it to them. So I think to me, short term, it's a distraction, but overall long term, I think it's good for the industry.
No, Matt, your fund is not committed to just quantum. So how do you think non-quantum specialist funds, how do you think they are viewing the quantum opportunity at the moment?
So if you look at specialized fund, Quantonation and others, for them, I mean, no hesitation. They are full speed and they are investing in quantum, whatever. Then if you look at larger investors that can write bigger checks, they need to get used to long-term return. This is the first element. If you look at space and satellite business or space economy, we know it will take time. And when you're a big fund and you need to generate return, like short term, there is a timeline issue. So this is the first element where I think generalist large investor may still be a bit hesitant. The other big reason, and this is happening today, it's exactly what you mentioned, Olivier, that if you're a big fund and you're managing billions, you can invest T-bills, 7%, zero risk. You can invest in a new tech that got risk and you got to take a bet. Do you go for ion trap? Do you go for spin qubit? And you don't know because you're not an expert in the quantum field. So I would say hesitant for large firms, but for reasons that are not quantum reasons, for reasons that are deep tech reasons. I'm sure that if you look at the beginning of the world of computing back 30, 40 years ago, they were facing similar issues. So you need to have either investors who do have an interest, government agencies who need to pull the technology for this sovereignty or regional matters, or experts that do help quantum computing and the full quantum stack to grow.
So I want to move on the theme. So startups need to grow. They need to grow their funding base. But the priorities for investors change and evolve between seed, Series A, Series B, and startups need to grow that funding base. They also need to manage their valuation journey across those stages. And from a scientific founder's point of view, venture-style valuation methods can seem ephemeral, is the politest word I was going to come up to you. So Nardo, in looking at that journey, I want to focus first on the early stage. University IP, grant funding, it can seem a boom, a boon to the startup. But there are also traps. What mistakes do we need to avoid at those early stages?
Yeah, there are definitely many there. There are a lot of early stage that get stuck in what I call the research cycle. They can never become a startup. They just do grant funding after grant funding. Then all of a sudden, like 20 years in, they figured that they needed to create a company, right? So that's one area. The other area is the ownership of IP in terms of your strategy related to things like, okay, well, at what point do you need to get out of the university, right? So there's a transition component, and you need to time that correctly. Things like Does the university own a lot of the IP now? But when you start your company, how are you going to strategize on what the company owns and what you do in the company? What are trade secrets that you need to do? Things like that. So the strategy on the IP aspect. Another one is, I see this quite often, researchers love publications, and researchers like presentations and being cited on many different journals and things like that, but not knowing that they're already providing their IP out there. So that's also a big mistake, and that usually, when that happens, it loses out on the valuation and defensibility of many, many different things. So those just are a few of things. I could probably name 20 more on that.
So Matt, I wanted to move it along to along those stages as we move to later stages in the funding cycles. How do the priorities and the basis of valuation change, and what are the traps to avoid there?
I would say in terms of valuation, if you're super early, you look at a market, you look at a potential, you discuss with experts, and you try to base a company value according to the size of the round and the dilution. So you're playing and you kind of think, yeah, best guess and exit could be this way, this way. So it's not like based on rock solid equation that will tell you valuation is 12.5. That's for sure. And that's why you talk with experts and you need physicists to assess deals and potential and people and team. When you start to grow and you write bigger checks, you're looking for different type of investors. They are much more financial oriented. And if I go Series C and later, you talk with an investor, instead of asking you what are the specificity of the ion trap versus a spin qubit, guy will tell you what's your gross margin, how machine you will launch, and what the revenue, and what your free cash flow. And so this is the first big difference between early stage moving to later stage. Different investors, different expectation, and different value from the investors to the company. The second element, which is the trap you mentioned, the question you ask is around, you need to have the equity story and you need to be consistent over time. It means that round after round, you increase the check size that you request from your investors, you increase the valuation, but you need to increase the financial metrics or make them better. You need to decrease the level of risks, or you see the potential level of return for your investors. And if you start to break one of those lines, call it revenues, gross margin, level of risk, check size, valuation. If you start to face a disconnect, the next round will be a hell to raise. Because you will never be able to explain why you got a valuation at 200 million pre, and you're not generating revenues, and you will not generate a return, and you got risk in the technology, so that does not work. So to me, the trap that you got to be super careful to avoid is make sure the equity story on those various lines move together on the right way, obviously.
Mm-hmm. Olivier, you already referred to the SPACs and the boom and the bust that we've seen. I wonder if you could talk a little bit more about the challenges that raises for us, and what can we do to attract follow-on investors with deep pockets to fund the build-out of our portfolio companies at later stages?
I mean, for companies that have raised 500 million through a SPAC, it's fine because they have 5 years runway. They can use that money, so it was a good way for them to finance. Now, for the one that came at the end and just got financing for 2 years and then the valuation dropped significantly, then it's going to be a hell more difficult. The consequence, well, we had a few companies that could have been candidates and that have been approached by SPACs, but we thought that they were not ready to be public yet. You have to have a certain level of maturity. You have to be able to keep on releasing news and progress quarter after quarter. You need to have a team that will support reporting and so on. So it's not cut for all companies. And sometimes you're better off and just building on just what Matt said, you're better off with reasonable valuation, but improving round after round, and we are not pushing for very strong valuation because it makes it even more difficult for the next round. Deep tech and especially quantum is a long journey, and the company is going to have to finance every 18 to 24 months. So that means, if you're already after 2 or 3 years more than 100 million valuation, then the journey is going to be quite long.
If I can add on that one,
please.
SPAC, this special instrument exists since decades. But it was used 1 or twice a year for biotech in the US, for good reason. And when we had the crisis 2021, then people extract the cash from the stock market, from the various position, but this cash did not disappear. This cash was in the pocket of those investors, and they said, I need to deploy it. I need to deploy a big amount of cash quickly. Then some guys say, look, SPAC, we can do that, that's great. And look at the trend of the deep tech, and this will change the world. So here we've got plenty of targets. So I don't know, maybe 300, 350 SPACs were raised in 21 in the US. And once a SPAC is raised, the sponsor got 24 months to find a target and to execute the reverse merge. If not, you need to reimburse the investors, including the management fees, which are roughly 20, 30, 40 million. So this is the volume of SPAC open. And on the other side, companies who are raised, I don't know, 20, 30 million, maybe 100 million, they got two options. They keep going to private investors, but they're asking questions and they're on their back all day. It's not easy, and you raise money every 24 months. It's tough for founders. And on the other side, you got some very famous people who say, look, come with me, I give you 300 million. 300. Look, the value of your shares. You own 30% of the company. Imagine how big that will be. So those people were pulled or trapped into this dynamic. But when you enter in the stock market, I mean, the SPAC, the cash you got from the SPAC, if you don't have too much redemption, is the cash you need up to profitability. That means revenue, cash flow, stability. And look, we're discussing quantum computing and quantum software since a day and a half. We know that it's growing, it's maturing, but if you discuss with a non-specialist, they will tell you, yeah, look, I discussed to Alain Aspect, he said, and will never see in my life a quantum computer at scale. So investors, what do they say? They say, no, not ready. You will not have the right cash flow. So then valuations start to drop on the stock market, and need to raise money, and it make your balance sheet weaker. So we got this wrong dynamic where people were trapped, we say, for bad reasons.
I want to move on now to a bit more specifically quantum stuff. So obviously quantum computing already it's got a blizzard of value chain participations in its own right, but also there's cryptography, there's networking, there's sensing, and you know, clearly any individual startup pitch has to stand on its own merits. But I wanted to come to each of the panelists about where they think, which segments of this wider ecosystem, which segments do we think are starting to look a bit crowded, and where do we think there's more opportunity? Nardo, do you want to lead us off on this?
Yeah, sure. So lately, definitely two industries that's been bugging me on how quantum applies to the industry. One is healthcare, a very big one. It's not pharma, but healthcare, right? So healthcare has different challenges, and a lot of people think that healthcare is all about the clinical aspect, right? So things like things like X-rays and MRIs and all the clinical activities and diagnostic activities. But healthcare is a big industry, so there's a lot of things to solve. Things like administrative functions, business operations, financial functions. These are all optimization type issues we have in healthcare. Things, for example, nurse scheduling, OR scheduling. These are very complicated things. You have big teams inside of healthcare industries trying to do that. Healthcare is one thing. And then the other one that I keep getting a lot of questions on, all of a sudden there's this, the need for quantum agriculture from a sustainability perspective. So if you take a look at we have a lot of food desert, we have a lot of food issues, we have a lot of climate issues within this area, energy issues, you know, things like bad fertilizers and climate issues, trying to predict when would be the right time to plant certain things, soil composition. There's a lot of requirements there for agriculture. So I'm getting a lot of questions in those. So I am bullish on those two industries from an early stage standpoint, just because there's going to be quite a bit of impact from both a societal and industry perspective.
So Olivier, what's looking crowded? Where are the opportunities?
Well, first, I think on a geographical point of view, we've seen a lot of companies created in North America and Europe these last years, but we are seeing more and more companies emerging from APAC in Japan, Korea, Singapore, and Australia. And we expect that there will be more of them because there is research, there is quality in academia and research there, so it will eventually lead to startup creation. The second thing we expect more in the coming years is software companies, because people have spent time building the hardware, Now it's starting to work, of course. It's not yet perfect, it's not yet at scale, but it's starting to work. And as the hardware nicely develops, then we will see more and more applications company. Maybe not for now, but in 3 to 4 years, there will be some nice one. And one thing that we are already starting to think, but I think this trend is going to intensify, is all the, let's say, shared infrastructure or middleware infrastructure that can be shared by several players. It seems that a lot of companies are all building their own system, their own infrastructure, and it does not seem like an excellent value for the money people are investing in the companies if everyone's replicating the same thing. So more shared infrastructure could also be a nice business model.
Matt, what's crowded? Where are the opportunities?
I mean, crowded, I think Quantum is too young to be crowded, so you can invest and do things anywhere. If I need to, to mention two segments where I believe there is a need. First one will be on connectivity and interconnect. I would say even more generally, technology that will enable scaling for the hardware. Because today, do you scale your machine? Do you connect machine that make a bigger machine to have more capacity? I don't have those answers, but here, connection or scaling enabling technologies. The second element, and this is something we started discussing within our team at AV back a few years ago, at Q2B in San Francisco, I think it was 3-4 years ago, Eric Schmidt was running the opening speech. He said, Quantum is here, Quantum is coming, Quantum will very soon. And this is a huge threat for data protection, RSA, and cryptography. So the field of how can you protect your data being at rest in transit when computed from being cracked or hacked by a quantum computer. So it will not happen overnight because we saw the numbers in a presentation yesterday. It requires a lot of logical qubit and a bit of time, but it will happen. So for data in transit, I think we got options, we got the world of QKDs, and we see the things that are maturing. But if we could have startups that would offer technologies like a full homomorphic encryption, allowing data to be computed without being decrypted and resistant to a quantum computer, I think that would be good. And if you could encrypt those data directly on your phone, directly at a sensor level, or when you take an IRM and MRI, if you could encrypt that at source and then run your machine learning algorithms through all the database of all the various hospitals in a given region, it would be beautiful. But today, we've got kind of latency and data inflation issues. I know some startups are working on. We did invest in one that seems to have good solutions, but it's not ready, not at scale. So this is a field where I believe for the world, for 8 billion people, could be very, very useful.
And by the way, even if computers are powerful enough only in 10 years, when you are Airbus and you are putting planes that are going to be in operation for 40 years, if you have not thought about how you are going to protect from hacking in 10 or 15 years, then it's already too late. So, which is why Airbus is heavily investing in quantum communications.
I guess so. We discussed with the team, a former Google, now Sandbox, that even crafted an acronym which was store now and decrypt later, saying, if you hack my bank account, data in 3 years, nobody would care about them. But you grab the drawing of the M51 or the Trident in the US, you know that those rings will remain confidential for decades. And hopefully, in decades, we'll have a quantum computer big enough and fast enough to break those RSA keys.
Let me move it on again. So we've seen a first wave of startups across all of these leading ecosystems that we commonly talk about. Nardo, a lot of impressive academics have gone into startups in those first waves. Where are we going to find the leaders for another wave of startups? Is there a shortage?
Yeah, but I think the hope there is because right now we're in what I call the technologies phase, right? We're building at the bottom of the infrastructure pieces of it, which requires a lot of the scientific and very, very technical aspect, right? So that's where the startups are right now. But as we progress in educating the industries, right, I'm seeing startup founders coming out of industry. So let's say I'm a deep tech founder. I used to do blockchain, and now all of a sudden I'm doing post-quantum cryptography on top of a Web3 platform. So I could see deep tech founders actually moving into that. I could see life sciences founders that's in the biotech space that may move into quantum mainly because they can see quantum as a computing area. I'm seeing it now. I'm seeing startups in the area of aging and longevity, where they're trying to produce drugs that can actually counter that and make us live 200 years old. I don't know if I want to do that. Maybe I would. So I could see the chat GPT moment for quantum technologies. I think that's an area that we probably will see a lot more. And then I'm seeing a lot of the quantum education going down, even down to high school level. So I think as we're seeing that level of education, it's becoming, all these universities are so aware of quantum information science, and because of that, I think we're doing it on both ends, right? So on the university level, on the startup level, where the cross-section of deep tech founders over to this industry, that's probably the next wave.
One thing that we're witnessing as well is our more and more initiatives with startup studios or accelerators that are launching all over the world. I can mention the one in Basel, nice initiatives with Uptown Basel. There's one in Sherbrooke that's in the making and that's coming out. There are a few in the US, one project in France. And I think this is important because some projects are still in the universities, not quite ready to go out and need to be refined. Need a bit of crafting before being able to raise funds. And we are seeing that in many regions. So the ecosystem in itself is also structuring, and those startup studios are a good answer to creating the less obvious companies than the ones that have been created in the last month.
Matt, broadening it a bit as well. I mean, overall, what bottlenecks do you see in us starting up and progressing these businesses?
So as we're discussing quantum, I see two elements. It's a day of two because we talk quantum always. The first is that it takes time to train a good quantum physicist. I mean, university, PhDs, etc. So you cannot grow or train enough people fast enough because it takes time. It's deep science, as you rightly say, Nardo. The second element, and this is maybe specific to quantum and a couple of other fields, is that you got this sovereignty angle that is growing a bit everywhere. I mean, you hear Russia, US, China, Taiwan, but even in Europe, you could see some programs that are, oh, this is a German quantum program, this is a French or a Danish or Netherlands. So, and my concern is that if you're creating a company, you're raising money and you want to scale, the bigger the market is, the better. But if you start to be trapped in one region, I mean, first you got to better be trapped in a large region. The US is better than France in terms of size of market and exit. So we think, I think we need to explain to governments and various regions that recreating those borders may not be the right move for deep tech like quantum, because it's true that you got those sovereign effects. So when I'm looking at the way AV we are structured between US, Europe, Japan, we always looking for this cross-borders, cross-region growth. But geopolitics could be a kind of roadblocks that would prevent those companies to scale.
Yeah, I would add to that. So I completely agree with this. So I pretty much traveled Europe, UK, Asia, and trying to figure out how the venture landscape looks like, right, for early stage. And one thing that I'm finding is, because of this siloing aspect, is a lot of the venture firms in each of the country want to be in the very early stage. And what I'm proposing is really this cross-border approach towards pre-seed investing, right? So this is usually the trap. The trap happens when a startup coming out of outside of the U.S. type of investment landscape, right? They would get pre-seed only in one country, and then that pre-seed basically will take on a significant chunk. So the moment you take on a significant chunk, you go to the U.S. market. The U.S. market will, the VC market will look at that and say, like, oh my gosh, I need to rework the cap table, right? So that is usually a bad sign for a startup trying to get into the U.S. market. So what I'm thinking was, okay, maybe a U.S. investor and whatever other country investor could collaborate on the pre-seed level, so you could do that cross-border market aspect of it, so for the benefit of the startup, right? I think that concept is a very hard concept to break through, mainly because the way VC firms are graded is based on the equity holdings that we have in these companies at the early stage, right? So I think we have some work to do there, but I think that idea of cross-border collaboration and market and equity ownership would be great.
And look, it starts with the VCs themselves and they're LP based. If you're in a given country and 100% of your investors as a VC, as a GP, comes from one single country, it would be tough to convince them to invest in another region. So when we created the AV Fund 4, we said we need to have like Japanese, Singaporean, European, US investors. And in some area of the world, it resonated extremely well, especially in small countries like Luxembourg, or very large countries like in the US. But for countries in between, they're like, if I invest in your fund, I want my cash to be deployed in my country or my region. But this goes exactly against what we said. We say we need to look for the right talent at the right market anywhere, and then help those companies to grow, hoping that this sovereignty angle will not increase but decrease over time. Yeah. I hope so.
I wanted to talk about a parallel question with Olivier, because we've talked a lot about from the startup point of view. But do we need to also think and talk more about the opportunities that business consolidation brings? I know you've had some success with that in your own portfolio, Olivier.
Well, yes, we already have 2 companies that have merged together in our portfolio. I think we will see that even more. Because you have company with a lot of resource, but lacking some specific bricks or specific skills or technologies, and some others that have developed nice products or nice applications, but that will be difficult to make a sizable business with. So we are expecting more consolidation. It might come between quantum startups themselves, but it might also come from industry. And actually, so we had 2 exits already in our first fund. The first one was to corporate industrial who bought the company because he wanted to get into quantum, and so he went it through acquiring the team and the developments. And the second one was 2 quantum companies merging together, one hardware and one software companies, to build a full stack company. So I guess we will see more of those in the future because I mean, some nice technologies being developed, but not all companies have the potential to grow at scale.
Now, please do be thinking of questions you want to put to the panel, and I'll just do another round of questions while you're thinking up your own. We've touched a little bit on the geopolitical aspect, and ultimately almost everything you can think about in quantum is dual use in some way, and the geopolitical edges are just beginning to harden up. Olivier, how do you think that's going to affect the venture market in quantum?
Well, first, you have to realize that when we raised our first fund, if you look strictly at ESG criteria, you cannot invest in defense. Which is something when you are in quantum, which is difficult to do. So we discuss with our LPs and remove that clause. So just a few sectors that are not allowed, tobacco, drug, whatever. But we can, of course, invest in companies that have use cases in defense. It's both an opportunity and difficulty as well, because when you talk about defense, you talk about export control, you talk about regulation. So it's a market, and it's a market that will pay for applications and will help the company develop. But at the same time, it will also make it difficult for some company to export, to establish collaboration in other countries. And so joining Nardo and Matt on this, I believe that the sovereignty issues that goes with it have more bad consequences than good ones.
Now, Matt, I may come back to you again on this, but I want to make sure we've got time for audience questions. So do we have questions from the audience? I see one hand at the front here. Will.
Thanks very much for a very informative discussion. I actually want to follow up on that question and Nardo's earlier suggestion. As a founder, I really like the idea of being able to look beyond my own borders for funding, because that really allows us to be more flexible in our fundraising. But there are two problems that I see with that. And one is, especially in the U.S., there's the CFIUS regulations, which is making it harder for us to contemplate that kind of thing. And the export controls also, but I don't think that's as bad an issue. But the other problem that I see is legal issues from corporation bylaws, and it's hard enough to try to consolidate them across states in the U.S. But how can you comment about what your plan would be if you want to do this cross-border kind of investing club, if you would? How would you address those kinds of legal corporation issues?
Yeah, normally, whenever you do a VC fund, you're usually geographically located, right? And what that does to you is you basically have to look at the laws that's just within your geographical area. And the issue with that is you don't get educated and you don't hire the right kind of people to do this for you, right? So there are a lot of international lawyers that actually does act as a bridge on, what happens from a CFIUS perspective, what happens from how you deal with Asia, how you deal with Europe when it comes to these cross-border collaborations. So that piece of it needs to. You just need to have the right kind of intersections to make that happen, right? The CFIUS aspect of it is not just a startup issue anymore. It's also become a VC issue too, right? From a VC perspective, we're going to be mandated to do a lot more reporting. They're going to be looking at who's behind the fund in many aspects. So that's also upcoming as well. It's going to be a little tricky, and there's going to be a lot of reporting on what are you using the money for, right? The use of proceeds. So whenever, and this is something that I normally advise startups, is to always create, at the early stage, become much more data-driven, right? So when I say data-driven, for not just for investment purposes, but also to address this cross-collaboration aspect of it. 5 slides you need to have. One is your company traction, your product traction, your technology traction, your market traction, revenue and valuation. Actually, 6 slides. Okay, and the reason startups are not good with data, right? So be data-driven at the very beginning. Show that progression and show how your technology is being used. Because the moment you don't do that, then basically you fall into the trap.
I want to try and fit in another question if we have one.
Just tell me when you're looking for the question.
Yeah, please.
Involve your board members. Open an independent board seat to welcome someone who got a different culture, different background, who can help you on, addressing those questions, because they are key and you need to start early.
Do I see any other questions?
And just while you're still looking, for us it makes very pragmatic consequences for us is that usually when we invest in Europe or in Canada, we aim at 15% ownership in the companies in which we invest. In the US, we target below 10%. And we usually part of the governance with board seat, and it's something that we don't do in the US as well. So it does not make it impossible to invest. It just requires slight adaptation.
So I want to put one final rapid-fire question to the panel to wrap up. So the global economy is facing headwinds, and quantum's coming off a wave of hype. So what quantum weather do we need to advise our startups to dress for? Winter overcoats or just a sensible jacket? Nardo,
I think
how to dress?
Quantum fall, not actually winter. So wear one of those convertible jackets where you have an internal vest, right? so you can be prepared for whatever it comes, right? So my perspective is right now we're in the vest mode, but we're not out there yet, right?
We advise our portfolio companies trying not to raise in 2023, first thing. And second thing, I think as the segment and market is progressing, there will be more demonstration about useful use cases in communications, starting to build networks, in computing, starting to have real industrial case. And I think this will help to bring back more attraction and more investment to the sector.
What, less advice?
No, but definitely light, because just look at today we got a Q2B session, you got use cases. You see more and more industrial and corporate players joining the room, understanding, looking for real use cases, and they do have first results. So that's demonstrating that it works and it brings value. Now there is a second element, the one we mentioned a bit earlier. Interest rate were raised by another 25 basis points this morning by the Fed, last night. You saw this West Pacific Bank in difficult situation, that's the fourth one. So those global macroeconomical trends are interfering in this global beautiful story of the future of quantum computers. So I think we got to monitor the macroeconomics for the next month, because if it stays the way it is, for VCs it will be how to protect your portfolio company to go through this winter, which is not a quantum winter, but it's an economical winter or macro winter.